Hello, and welcome to Principles of Macroeconomics. This is Module 7.3, Foreign Exchange and Exchange Rate Markets. Exchange rates reflect the value of one currency in terms of another. The Euro-US dollar exchange rate tells us the amount of euros that you would need to purchase one US dollar. Exchange rates tend to be determined by market forces such as supply and demand. There are two extremes in terms of exchange rate regimes. The first is floating exchange rates, where the value of the currency is determined by supply and demand and left up to market forces. The second is fixed exchange rate regimes. And fixed exchange rates tell us that the government determines the value of the currency and adjusts the supply of the currency to reflect that value. The demand for currency comes from foreigners wanting to buy domestic goods. The supply of currency into foreign exchange markets comes from domestic consumers wanting to buy foreign goods. In other words, the demand for US dollars comes from foreigners wanting to buy US goods. They need to purchase those goods using US dollars. The supply of US dollars into foreign exchange markets comes from US consumers wanting to buy foreign goods. They sell US dollars and purchase foreign currency for the purpose of purchasing foreign goods. The exchange rate equilibrates the supply of and the demand for currency. There are a number of factors that affect the exchange rate. The first is inflation rates. If the inflation rate in the US is low, the value of each dollar is high. That tells us that each dollar can purchase more goods and services. So if there's less US dollars in circulation, the value of each dollar is higher vis-a-vis other currencies, and the US dollar appreciates. The exchange rate appreciates. Next, interest rates also affect the exchange rate. High interest rates will indicate a high inflow of foreign capital. Therefore, there will be a greater demand for the domestic currency, and the domestic currency will appreciate. The exchange rate will appreciate. Next, a country's current account balance will also influence the exchange rate. Remember, a country's current account reflects net exports. So if the country is running a trade surplus, then that means it is exporting more than it is importing. And there will be a relatively high demand for US dollars in this case, and the value of US dollars will appreciate. Next, the terms of trade tell us the relative price of exports to imports. At a higher terms of trade, that tells us that the price of exports is rising relative to imports. This will reflect a greater demand for the country's currency, and therefore will increase the value of that currency and lead to an exchange rate appreciation. Also, political stability and risk in the political landscape influence the exchange rate. If there is high risk or high political instability in a country, capital will flow out of that country, and the exchange rate will therefore depreciate. Also, government debt. Foreign investors sell bonds if they predict an increase in government debt, and therefore this will also cause a decrease in the value of the currency and exchange rate depreciation. Lastly, a recession. Recessions are linked with low interest rates, and low interest rates tell us that there will be a net capital outflow as investors seek higher returns abroad. When that is the case, the demand for the domestic currency also falls, and we would experience a depreciation in the currency. So what have we discussed in this segment? Well, we've talked about what are exchange rates and how they are determined. We've talked about different types of exchange rate regimes, such as the floating and the fixed exchange rate regimes. And we've talked about factors that determine the level of the exchange rate. Thanks so much for joining me in Module 7.3.